Right now, Nuburu Inc. is trading at $0.34 a share, and it's up just a fraction, about 0.85% on the day. But that tiny green tick, that 0.0029 move, is one of the most misleading things you'll see on the market today. The immediate story here isn't this fractional gain. It's the fact that this company is in the middle of a frantic, full-scale pivot for its very survival, and it's doing so while juggling compliance warnings from the NYSE. Just last Monday, October 13th, the company announced it had received a warning letter from the NYSE American Exchange. The problem? It announced its new dual CEO structure on October 1st during trading hours, without giving the exchange the required advance notice. It's a procedural foul, but for a microcap stock, it's a terrible look. Then, just 3 days ago, on October 16th, the company issued another press release claiming it had restored NYSE compliance. This entire sequence is the kind of whipsaw news that defines a stock trading under $1, and it perfectly captures the immense gap between what investors think this company is and what it has been forced to become. The common belief, the market expectation, is that Nuburu is a straightforward, high-concept technology play. You see a stock this cheap, maybe on your Robinhood app or through SoFi Invest, and you see blue laser technology. Immediately, your mind goes to high-growth sectors, electric vehicles, 3D printing, advanced electronics. The expectation is that you're buying a tiny, undiscovered supplier that could one day be critical for welding copper in EV batteries, perhaps following a path remotely similar to the suppliers that feed giants like Tesla stock. You see it as a potential lottery ticket, an asymmetric bet on a new technology. You might even use Robinhood fractional shares to just get a small piece, thinking it's a simple investment. That is the story the market wants to believe. But the reality is profoundly different and far more complex. The reality is that Nuburu, the original blue laser R&B company, effectively ran out of road. A look at its financials from earlier this year tells the story. As of June 30, 2025, the company had cash and cash equivalents of just $111,090. That is not a typo. $111,000 for a public company. It was facing a going concern situation, meaning it was on the brink of insolvency, with an accumulated deficit swelling to over $150 million. The expectation of a simple tech growth story crashes directly into the reality of a company fighting for its life. The only reason it's still trading is a transformation plan that is less a pivot and more a complete identity transplant. In September, Nuburu managed to close a $12 million public offering. This wasn't growth capital, this was survival capital. And it came at a staggering cost to existing shareholders. Over the past year, the total shares outstanding have ballooned by an almost unbelievable 1793.6%. That is the definition of massive, painful dilution, where the company sells off huge chunks of itself just to keep the lights on. So, what is this transformation plan that was funded by that $12 million? This is the new reality. Nuburu is no longer just a laser company. It is aggressively using its public stock as a currency to acquire other businesses, specifically in the defense and security sectors. The company has established Nuburu Defense LLC and is in the process of acquiring controlling stakes in companies like Tekne S.p.A, an Italian firm specializing in defense technology, and just announced its intent to acquire Orbit S.r.l, a SaaS company for operational resilience. This is the reason for the new dual CEO structure that got them in trouble with the NYSE. They are trying to bolt on entirely new, complex businesses in a different country and a different industry. The blue laser technology hasn't been abandoned. Rather, the new plan is to try and integrate it into these new defense applications. So, if you bought this stock thinking you were investing in EV battery manufacturing, you are now in reality an investor in an Italian Italian defense and SaaS holding company that is dangerously low on cash. Its cash position was cited at approximately $6 million after the $12 million raise in late September, and is being run by a brand new, complex dual CEO leadership team. This context changes the entire picture of the stock's recent movement. The daily swings you see, like today's tiny gain, are not based on fundamentals, earnings, or sector momentum in the way you'd analyze Apple stock or Nvidia stock. This stock is not moving with the broader tech market. It is moving entirely on press releases. The $12 million offering in September, the dual CEO announcement October 1st, the NYSE warning October 13th, the company's compliance restored announcement October 16th. This is what dictates the price. The 52-week range, which has been as low as 0.12 and as high as 0.99, is a testament to this volatility. It's a trader's environment, not an investor. This is the absolute opposite of what you'd find in Schwab Intelligent portfolios or a stable Fidelity mutual fund. Those platforms are built for stability. This is a pure gamble on management's ability to execute. For anyone using online investing platforms, from a sophisticated interactive broker's account to a beginner-friendly SoFi trading platform, BURU represents the far end of the risk spectrum. Fidelity offers a robust Fidelity trading platform, and you can certainly open an individual brokerage account to buy this. But this is not a Fidelity wealth management pick. This is not something that would ever appear in Fidelity ETFs or Fidelity IRAs. This is speculative, self-investing, plain and simple. Platforms like Robinhood Stock Trading and SoFi make the active invest online very easy, but they don't always convey the sheer operational and financial risk of a company like this. It's not a stock, it's a bet. On a turnaround, so let's briefly look at the original business, because it is the foundation. Nuburu was founded on a genuinely interesting concept. Traditional industrial lasers, infrared, are poorly absorbed by metals like copper and aluminum. This results in a lot of spatter and inefficient welds. Nuburu's blue laser technology, by contrast, is much more readily absorbed by these metals, allowing for faster, cleaner, spatter-free welding. This has obvious and exciting applications in e-mobility, welding copper battery components, consumer electronics, and 3D metal printing. This was the expectation story, but the reality is that commercializing this technology and achieving mass adoption is incredibly capital-intensive and slow. Nuburu couldn't fund that long road, which led to the cash crunch and the current desperate pivot. Looking forward, the tension between expectation and reality becomes even starker. The expectation is that one of these days, Nuburu will announce a huge contract with a major automaker, the blue laser tech will be validated, and the stock will rip. The reality is that the company's future now has almost nothing to do with that. The future is a binary bet on the transformation plan. Can the new dual CEOs successfully integrate Tekne and Orbit? Can they leverage these new defense and SaaS businesses to generate actual sustainable revenue before the $6 million in cash runs out? The $12 million offering bought them time, but not much. The single biggest risk, besides outright failure, is more dilution. They will likely need to raise more capital, which means more offerings or a reverse stock split just to stay compliant with the NYSE's minimum bid price. The defense and security hub they're building is the only story that matters. This is a critical moment for the company. They are attempting to bolt on revenue streams from established, though likely small defense companies to fund the high-cost, high-potential R&D of the original laser business. It's a financial maneuver. Comment below if you think this pivot into defense is a brilliant survival move or a desperate high-risk gamble. This isn't one for the intelligent portfolio. This is for traders who read SEC filings and press releases with a magnifying glass. The recent NYSE warning, even if resolved, shows the strain the company is under. In the end, the disconnect is profound. The market ticker says BURU, a 0.34 laser tech stock. But the reality is you're looking at a distressed holding company, massively diluted, pivoting into Italian defense and SaaS, all while trying to stay on the right side of its exchange. The expectation is a simple tech bet. The reality is a complex international M&A turnaround story that is hanging by a thread. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up! Don't forget to like, comment, and share this video to support the channel. Heart to you!